Um, this is your mortgage guy, Dave Steinberg, back with your Mortgages Made Easy podcast. And I'm delighted to have Ben Brasier with us. Ben is an expert on reverse mortgages. And we're going to talk about reverse mortgages for seniors and how it helps the senior live better in retirement. So, Ben, what are some typical scenarios you see for someone in their 60s who own a home and don't know what the best? Let me try that again. Ben, what are some strategies you see that are really effective for seniors?
Well, there's a few different ones that come to mind, and it really depends on the starting point, of the person that we're talking about. Very typically, it will be somebody who is approaching retirement that is still carrying mortgage debt on their home and trying to get by on Social Security while also trying to make mortgage payments. Is kind of a non-starter. You know what I mean? Most people just won't be able to do it. They'll end up having to work forever, more or less. And with a reverse, we would pay off the existing mortgage. There may be some additional cash or line of credit available to the borrower, but just by simply eliminating that debt from their cash flow, it changes everything. We did a reverse for a young lady of 63 recently, and we paid off her mortgage, and I was checking in with her a couple of months down the road just to see how she was doing. It's one of my favorite parts about my job is hearing from people, after we get their reverse and seeing how they feel. And this person had been to Europe twice in 2 months, right? And this was just using the money that she had been paying on her mortgage. And so this is something that she had been wanting to do forever since her kids were kids. She's wanted to do this, and now everybody's fully grown and out of the house, and now she can do it. So that's one way that people are using a reverse. I mean, just having the extra cash is great for your longevity and for your state of mind and your peace of mind, I should say, and stress level. But being able to go and do the things that you've been wanting to do, that you've been putting off while you raise your family, that's tremendous. I really love that. Another way that people are using it, aside from just paying off mortgage debt, is to have a guaranteed line of credit for them, right? So you can set up a reverse to where it's making monthly payments to the homeowner for as long as they live in the house to supplement their Social Security. That's a great way to do it. But a lot of people are using it just to have a line of credit on tap. So the line of credit in the FHA reverse mortgage is guaranteed. Okay, so no matter what happens to the property value, whether that goes, up, down, or sideways, no matter what happens to the economy or interest rates or the borrower's credit or income, as long as the homeowner continues to live there and pay their property taxes and insurance, the line of credit is guaranteed to them, and it receives a growth rate. Let me say it again because it's weird. The line of credit in the FHA reverse mortgage, it gets a guaranteed tax-free growth rate. So the money that is available to the homeowner is growing at the same rate that the money that they borrow is growing. And so that this allows them to access more and more of their equity as time goes on. And so the way that I plan, go ahead.
Yeah, so if you're 62 or 65 and you take a reverse mortgage, and let's say they give you a $200,000 line, what you're saying is that in 10 years, they'll probably have a 400,000 line if they haven't used it.
Yeah, exactly. Exactly that. And it'll depend some on what interest rates do. So if interest rates go down, that growth will happen more slowly and vice versa. But yeah, that's my plan. And pretty much the plan of everybody in the reverse mortgage industry is to get their reverse mortgage as soon as they turn 62 for exactly that purpose, to have that line of credit, to receive that guaranteed growth.
Now, for someone who is worried about losing their job, how might a reverse mortgage come in useful?
Well, a lot of ways, okay? First and foremost, get the reverse right now while you still have that job, okay? Because you may need that income to qualify, okay? You lose that job, you might not be able to qualify for the reverse. So I would say get it now and then and then speak honestly with your boss about how you feel. But yeah, if you're afraid you might lose it, definitely get the reverse. It'll definitely take the sting off if you do lose it. And if you're thinking about quitting, definitely get the reverse first. Okay. Same with retirement. Get it first while you've got that extra income. Make sure you qualify for it. And then, with that peace of mind and that understanding, move forward.
Right. Because, let's say someone who's, I don't know, 62, 63, and they lose their job. Well, now they have basically the normal reaction would be, I'll have to draw Social Security early. But when someone draws Social Security and they're 62, 63, they're losing 30% or so of what they would otherwise get. And therefore, having a reverse mortgage that lets them put off drawing Social Security till their full retirement age, or maybe even till they're 70, means that the lifetime cash flow is radically enhanced.
No, you're right on the money there. No pun intended. And if getting rid of that mortgage payment with your reverse mortgage lets you delay taking Social Security until it's the perfect time for you, that's the way that a lot of people are using it. Because especially if you're looking at the amount of income that you get waiting for full retirement age, or even till 70 and a half, I believe it is, it's a pretty big difference. It's a pretty big difference. I think the last time I looked at it, if I remember correctly, the difference between 62 and 70 and a half was it was over 60% more money. Does that sound accurate? It's been a while since I've looked.
I'm not sure, but yeah, it sounds like it's significantly more. It's 30, 40, 50% more. And over the lifetime, especially if someone lives into their 80s and 90s, that would make a huge difference. There are lots of horror stories about reverse mortgages. They're going to take my house away.
Yeah.
What are my heirs going to end up with? What's the truth about this?
That's a good question. So in terms of the stigma about reverse mortgages, this comes from, in the past, things were a lot more loosey-goosey with how things could work. You had bad actors, people that sold, and I'm not slamming the annuities business. I'm just saying that in this story, there were people who sold both mortgages and annuities, and they would sell a reverse mortgage to the borrower. There were no limits at that time to how much of the cash the borrower could take at closing. So routinely, they would just take all of it and they would go buy this annuity. And then this bad actor would later sell that annuity, buy another annuity, earning themselves another commission, and would just repeat this and equity stripping the borrower every year without providing any additional benefit, right? So that's no longer allowed. Can't do that. Sorry, bad actors. The other thing had to do with what are called non-borrowing spouses. Okay, so the maximum amount that a household can borrow is based on the age of the youngest borrower. Okay, and so in the past, it was pretty common to take that younger borrower off title so that the older borrower would qualify for more money. But the problem with that, though, is that the older borrower will inevitably pass away first, and then the younger spouse is left being told that they now have to sell their house in order to pay off the reverse mortgage. And these people would occasionally get on the news and they would say, oh, this evil reverse mortgage company, I never understood what was happening. I didn't agree to this. Now they're telling me my husband's died and now I have to sell the house. And isn't it terrible? And yes, it is terrible. So the FHA changed the rules. That's no longer allowed. So if a couple is married and they live together, then they both have to be on the reverse. And if that means they qualify for less because one spouse is younger, then that's just the way that it is. But the important thing is that all parties are protected. And now you're never in that position where, adding to the grief of losing your spouse, also having to deal with selling your house at the same time.
Now, so let's go back to today. And I think it's important for people to understand that when you take a reverse mortgage, you are not deeding your house to the bank, right?
No, right.
You're taking out a mortgage, same as any other mortgage. The mortgage will be a maximum whatever the maximum amount that you decide you want and that you qualify for. And then, so let's say you have a $500,000 house and you get a $300,000 mortgage.
Mhm.
When you move, whatever is not used
Mhm.
out of the funds in the reverse mortgage, plus the remaining equity in the house, goes to the homeowner. The homeowner can determine how to sell, when they want to sell, and anything remaining goes to the homeowner, right?
Absolutely correct. Yeah. So a reverse mortgage is just a mortgage. Okay. So the homeowner remains the homeowner. There's just a lien on the house, same as any other mortgage, right? And then any money that is available to the borrower in their line of credit, okay, or you could also say money that the borrower had available to them that they never borrowed, right, is not part of the payoff. And so just as you said, the borrower can sell the house if and when they want to. And then the reverse just gets paid off like any other mortgage, and the remainder of those proceeds goes to the borrower or to their heirs or their estate.
I guess the other thing that is important for people to know is that reverse mortgages require that you live in the house as your primary residence. So let's say you live in New York or in New Jersey, and now you're buying a property in Florida.
Mhm.
If the property in New York remains your primary residence, no actions required on the reverse mortgage. But at the point that, let's say, you relocate and now you're going to make your Florida home your primary residence, that triggers the obligation to notify the bank, and then what happens to the reverse mortgage at that point?
And we're saying the reverse mortgage is on the New York property, right?
Yeah.
Okay. So once you move out of the house, okay, or if you are out of the house for 12 continuous months, okay, then it's time to pay off the reverse, right? And so you could do that a couple of different ways. Most likely what would happen is that person would sell their New York or their New Jersey house, okay, pay off the reverse, pocket the remainder of those proceeds, and then live happily ever after in Florida. And you could do it the other way around as well. You could sell the New York, New Jersey house, take those proceeds, put some or all of them down, and use a reverse mortgage to purchase that Florida house, and be settled forever like that.
And the same, in the unfortunate situation, if, let's say, the occupant or occupants of the home pass away,
Mhm.
then their heirs step into the place. Obviously, the borrowers are no longer alive, so they must settle on the reverse mortgage, but they have 6 to 12 months, right? It's not like the next day the bank puts the hammer down.
Exactly. So the bank will begin the foreclosure process, okay, just so that they have all their ducks in a row, because they will not immediately know if this borrower has heirs or not, okay. But the heirs will contact the reverse mortgage company, just call the phone number that's on the monthly statement, and they will say, so and so has passed on, we are the heirs of the property, we are going to refinance this reverse mortgage and keep the house, or we are going to sell this house and take the remaining equity, okay, or something like that. And so they get 6 months with up to 2-3 month extensions to make that happen, okay. And in order to get the extensions, you're going to have to request it from the servicer, okay, from the lender, and they'll need to show that they're making a good faith effort to do whatever it is they said they were doing. So if they need to remodel the house before they can sell it for top dollar, which is, not an uncommon happening. We see a lot of deferred maintenance, during retirement. Then they would just show that they're doing that, and if they're working on getting a refinance or what have you, they'll just show that they're making that good faith effort and get those extensions. So yeah, 6 to 12 months.
Well, thank you so much, Ben. Really a pleasure talking to you. For our listeners, if you have any questions about reverse mortgages, give me a call. Happy to walk you through the options. Happy to show you what the calculations look like. Ben, thank you again so much for joining us. And I'm your mortgage guy, Dave Steinberg, and this is your Mortgages Made Easy podcast. Thank you.
Thank you, Dave.